As with most other years, 2021 brought fascinating developments in the financial markets, especially as the path from the pandemic was far from certain. However, some analysts say the performance of the financial markets generally fell in line with expectation as fiscal and monetary stimulus packages resulted in a pull to none. Let's bring in Tajuddin Ibrahim now, the Director of Research and Strategy at Chapel Hill, Durham, to talk to us more about the market in the year. Good morning, Mr. Ibrahim. Thank you very much for joining us on the program.
Good morning, and thank you for having me.
Well, the strong start to the year in the equities market was kind of derailed by the upward retracement in fixed income yields before impressive corporate earnings lifted market performance in the third quarter of the year. How would you describe the performance of both markets this year, and what were the major drivers?
Well, I think the major development in the fixed income market, for instance, is a case of repricing of fixed income assets in that market in the third quarter and also subsequently in the fourth quarter of this year. We noticed that yields were elevated in the second quarter, largely speaking, because we had a bit of aggressiveness on the supply of bonds to the market. But when we began to see a slowdown on both the bond and also the T-bills market, interest rates or yields on those instruments began to drop, and equities, now became sort of more attractive to investors. We also bear in mind, some sort of corporate announcements that underpinned the performance of the equities market in the third and fourth quarter of this year. We bear in mind also the strong earnings delivered by companies and sectors in the equities market. So these factors were responsible for the positive gain that we have seen so far this year in the equities market, for instance. But we bear in mind also that yields in the fixed income and money market spaces are still, somewhat, below, levels that we saw in the second quarter. To be specific, 1-year T-bills, for instance, cleared at 5% discount rate in the last, primary auction for last week. That is a very cheap source of, borrowing for the government, in my view. So the two markets have not really performed badly this year. It is just that inflation has been, somewhat stubborn despite falling. But we like the fact that economic recovery has been, broadly speaking, positive and steady in year 2021 so far.
Now, 2022 being a pre-election year, how do you see the sensitivity of markets to events in the political landscape?
Well, I think for 2022, a market sensitivity to political development, I think naturally speaking in this country, you would see enormous volatility in the market when we have, election coming up, largely speaking in pre-election years. But those years have, passed, and those were years that the market was, largely controlled by foreign investors. Foreign investors, naturally, when we are about a year to election, would leave the Nigerian market and, look for, safer markets, either in the developed market or in the emerging market. But, this time we have a different development because most of the foreign investors in the market have exited, and we have, mostly speaking, the local investors. And we would expect that the local investors, would not, shun the market because of pre-election. And what we even expect is increased participation in the market because we have the locals playing the market as we speak. We are all in this market. We are going nowhere. We have no other country to go to. We have no other markets to invest in other than this market of ours. So my expectation is that the election next, the pre-election year, being 2022, will not be a damaging one for the stock market and the capital market as a whole, in my view.
Okay, now, I like that hope that you have portrayed, that optimism. But then I think sometime last week, the Securities and Exchange Commission came up with an announcement about transaction fees or increasing the transaction fees, fixed income market starting from January. And looking at that, a lot of people would think that that would actually discourage, some potential investors, local investors, as you may call them, from getting into the market or even investing, because that is going to impact the return to their investment. What do you think?
Well, I think the impact on returns, let me start with that, would not be material because the fees they are looking to charge is, below a level that could negatively impact, returns in that market. That is one. The second thing I think for everyone to bear in mind is that, this development is in line with regulation. It is in line with the rules and regulation, of the Securities and Exchange Commission. So, the market, in my view, should welcome it. And look for ways to improve on the yields on their portfolio and accommodate this new charge that the SEC has brought forward. My view is that institutional investors are largely speaking the players in the money market and also in the bond market. So retail investors are not, that much in terms of, their impact. So what I expect is for the institutions to take these fees and, look for other ways to improve on the returns on their portfolio. We bear in mind that the government needs more revenue to finance the budget. And this looks to me like one of the ways that the SEC wants to rake in higher revenue in 2022. In my view, it is in line and consistent.
So, in other words, we are likely to see kind of periodic portfolio rebalancing, in the coming year.
So if they were to rebalance their portfolios, where would they go to? So that was the first question. And, the beneficiary in that case would then be the equities market. And one thing that I know for sure is that, portfolio investors, mostly speaking, the pension fund administrators, are not really playing much in the equities market. They are not up to the, required limit by the regulator. So most of them will still leave their funds in the fixed income space, irrespective of, the newly introduced fee by the SEC. So they will take it, in my view. And if they have to move a bit, it will be to equities. And I do not expect an aggressive move to equities because of that.
Okay. Now, Nigeria was able to tap the Eurobond market for capital in 2021. What should we expect in 2022?
For money markets?
Yeah.
Yes, okay. For money market, I think what investors, should expect is, a repricing of yields in that space in 2022. I just said earlier on that it is looking likely that we close 2021 with the discount rate on one-year treasury bills being around, 5% or, a bit lower than that. That number is materially below inflation, which is 15.4%. That means negative real return for investors in that case. That number also is below, the monetary policy rate, which is 11.5%. So my sense is that, next year we'll probably see in what we call normalization of monetary policy by the CBN, and if that materializes, investors should expect higher yield on treasury bills in 2022, and it will be a market for most investors to play in. But I sense that there will be issuances of commercial papers in 2022 before we see a repricing of yields, as corporates would like to take advantage of the low money market rates to issue commercial papers and support their own liquidity position, in my view.
Okay, so given your expectations of yield elevation in the fixed income market and probably a heated political climate that characterizes a pre-election year, how do you see that impacting the equities market?
Okay, so for equities, I think my view around equities is that we most likely are going to see investors, try to purchase higher yield, higher dividend stocks. As we speak, we have, some listed equities or stocks that have more compelling dividend yields than what you can get on one-year treasury bills. For one-year treasury bills, you will get around 5% as yield. But if you are buying Zenith, if you are buying Access Bank, if you are buying GTCO, if you are also buying some, high conviction names like Dangote Cement, MTN, most likely the dividend yield you will get will be well above what you would get in the treasury bill space, the money market space. So I expect investors in the first quarter of next year to shift to those names because of the compelling dividend yields in that space. So that's my expectation. I believe they will earn more for their portfolios if they diversify accordingly, away from money market and move more into high dividend yield stocks for the first quarter of 2022.
All right, thank you very much, Tajuddin Ibrahim, for being with us on the program this morning. We do appreciate your time.
Thank you for having me.